based upon the trajectory of the Federal Reserve and how overvalued we are in the stock market, it wouldn't surprise me at all if towards the end of this year and in spring of 2023, we saw a 40% decline plus from where we are right now. And that would just bring the total market cap of GDP back to 100%. Of course, that's assuming that GDP doesn't fall, and GDP is going to fall. Mm-hmm. So just to bring the market back into some semblance of reconciliation, valuation-wise, it would have to drop to about 40%.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Today's guest expert issued a loud warning last year that 2022 was going to see an economic slowdown and a market correction, largely due to the biggest monetary and fiscal cliffs in history, as the spigots pumping tens of trillions of dollars worth of stimulus into the global financial system turned off. Here in mid-2022, that prediction is looking very prescient. So, what does this expert see in store for the rest of the year? We're about to find out. I'm very pleased to welcome back one of the most requested guests on this program, money manager Michael Pento. Michael, it's wonderful to see you again, my friend. Thanks so much for taking the time to join us today.
Adam, believe me, it's completely my pleasure, and I'm so glad to be back on the program with you.
Thanks, Michael. Look, Mutual Admiration Society here, huge fan of yours, love talking with you. And as I said, you are the most requested guest on this program. It's been too long since we've had you on, so very glad we have you back on now. And we're going to remedy that going forward, trying to have you on a little bit more frequently. But my friend, as we always start with, I got a lot of questions for you, but let's start with the high level one. Answer any way you like. What's your current assessment of today's global economy and financial markets?
Well, Adam, not much has changed since I last been on with you as far as my disposition and my trading strategy. We had phase one of the bear market, which was a 20% decline in the S&P 500. The predicate there was, hey, we're heading into 2022. We have record high inflation, and there's keen anticipation of a Fed that's going to be very, very hawkish, on top of the most expensive stock market we've ever seen in history. So we had that decline. That was phase one. That lasted from basically early January all the way to the end of June. Phase two, which I believe is going to start very shortly here, it might have already started, but for sure, in my opinion, will start late September or October, is going to be an intense earnings and economic recession. And the predicate for that is going to be the bursting of the three biggest asset bubbles that existed concurrently in history: equity prices, bond prices, and of course, real estate. The recession is going to be so intense, in my opinion, that even Powell, Yellen, and Joe Biden will not be able to deny its existence.
Or change its definition?
Or change its definition. You know, people want to change, oh, it's, it's in a bear market, is it a recession? That's not the point. The point is, if for an investor, is to identify the rate of change of the rate of change, the second derivative of growth and inflation. And if growth and inflation are going to plunge precipitously, you have to make that move proactively in the portfolio. So did you do it or did you not do it? We have a model here. It's called the inflation, deflation, and economic cycle model. It identified the fact that the second derivative of growth, particularly, and even inflation, we are in a disinflationary environment now. It should morph into deflation if the Fed prosecutes on their plan, and we'll get into that later. So if you have a plunge in the rate of change of growth, you have to make changes to your allocation. We did so in late December, and we are getting ready to make another change heading into the second half of this year, as we're in the second half, or towards the fall and winter, when I expect the recession to grow particularly salient.
Okay, I want to dig into all of that with you. Let's start first with, you mentioned that you have a model. It was telling you to batten down the hatches coming into this year. How has that model performed so far in this year where, the markets were down anywhere from 20% to more? and they've recovered a little bit, but they're still down double digits. How's your model done?
So, I hate to quote a lot of returns here because the SEC always tells you, hey, if you quote one return, you got to quote all, or you can come to me and ask me or my staff anytime. I'll give you all of the returns for the entire existence of the model. But you ask me a specific question, we're down a little more than 1% so far in 2022. The primary reason for that, even though we have a net short position for our customers, is that the bond portion of the portfolio did not perform well. So you think about July. Why did July provide us with a bear market bounce? For many reasons why a bear market can bounce, and people come up with all kinds of excuses for one. But the primary reason was because Powell pivoted due to the fact that inflation peaked. Well, let's see if that happens. We don't get the inflation print till tomorrow. But if inflation peaked, it's peaking from 9.1% down to 8%. It's not going from 9% anywhere close to 2%. So we have ostensibly a Powell pivot, which is going to cause the stock market to rise. That hasn't happened yet, but people are hoping that the peak in bond yields will literally yield higher returns in the stock market. But no. Concomitant with lower bond yields is going to be a salient recession, which is going to bring earnings down. So peaking bond yields and peak inflation is going to equate with lower stock prices, just like it's done every other recession in history.
All right, I'm going to want to dig into that too, but first, in a year which first half of this year was one of the worst starts to the markets ever when you look at both combined stock and bond performance. In my book, being down 1% is basically essentially flat. I think in a market like this, flat is the new up. So anyways, kudos for being a good protector of capital in that portfolio. All right, so.
Well, can I add, I'm sorry,
Yeah.
I just want to say one thing. Now that we have the bond portion of our portfolio kicking in, those times where you say, well, you didn't make any money, but you protected our principal, God willing, we'll have both the bond and equity shorts kicking in. So we should hopefully provide our clients with a positive return as both the stocks, shorts, and equity and the bond longs do their job.
Start playing off. Okay. I want to get into both your specific market outlook for equity and bonds in a bit, but I'm going to take a macro path towards that answer if I can. So if memory serves, the last time you were on and I was pressing you to peer into your crystal ball, you sort of looked at the future. You divided it into sort of three phases, which may be different than the phases that you just mentioned, but let me see if I can remember correctly what we had talked about last time, where you said we're going to go through a period of disinflation, followed by a period of deflation, which will then engender a central planner response. There'll be a reversion back to easing. Not sure if that's the pivot or if that's a different act by the central planners, but essentially it's going to unleash a big inflationary response. So it was sort of disinflation to deflation to inflation. I see you nodding as I'm saying this. I've got some follow-up questions, but first, maybe let me just let you speak here and say, is that still the long arc that you see ahead?
Yes. So we had inflation 2021. We had inflation 2022, the first half. My guess was the second quarter would start to see that disinflation. War in Ukraine and Russia kind of, I guess, kicked that down the road a few months. But now we're going to clearly see between now and the end of the year, disinflation, the rate of change falling. And I do believe somewhere along that line, say late fall, early winter, at the latest the spring of 23, the Fed is going to freeze the credit markets as they always do. And I'm going to get specific as to where we are as compared to the last time the credit markets froze, and prove as best we can when we look into the future, that's going to happen again. And when the credit markets freeze, you get a plunge in asset prices. And that includes real estate. Yes, deflation is a very pronounced risk. And actually, I think when you say risk, That's what we need to reconcile these great imbalances. I mean, we don't need home prices going up 20% per annum. It just can't last because it's so far ahead incomes. So what we need is a grand reconciliation of asset prices. That includes equities. We see the bonds already starting to reconcile their prices. And we're going to get into all that. I know we have a long time, so I want to get to very specifically why I believe it's disinflation now and the very real risk of deflation, which is going to be pernicious in the short term, but absolutely essential and healthy in the long run.
Okay, great. And the last couple of times you and I have been on, we have, I think, covered a lot of the territory of what created this massive bubble in just about every financial asset, how we lament the institutions that played a big role in that, like the Federal Reserve, and how we also lament that we're at the point where, you know, we want a correction back to a more sustainable and fair baseline going forward, but we feel like we're beyond the point where we're going to be able to do that in a painless manner. And so we're just embracing, look, let's rip the Band-Aid off. Let's take the pain now and start, you know, the healing and getting to a better tomorrow sooner, rather than continuing to kick the can and making the eventual correction even more painful for folks. So won't recover a lot of that territory here. So we'll just talk about, okay, you know, how do we think we're going to go from the heights of the bubble down to the depths of whatever this looks like when the dust finally settles. A key component of that, as you've already sort of alluded to, is going to be, you know, where interest rates go from here. And what sort of changed the game this year, right, has been hot inflation. In many ways, that is forcing the Fed to take actions that it has not wanted to take for a long time. But it's now being forced to hike interest rates because inflation's so high. And we are going to find out the new inflation number tomorrow for July, but the latest data we have is a 42-year high, I think, of 9.1%. Like you said, even if that was the peak, it's probably not going to come too far off of that so far. So inflation's still going to be really elevated. So inflation's still a big problem. If you look at the markets right now, they've recovered about 50% of their losses from the June lows. At the same time, we just had a what I consider to be hard to believe, but bonanza jobs report, right? And so when I look at those three things together, still very elevated CPI, you know, rallying market, and crazily low unemployment numbers. To me, that seems to give the Fed more air cover to continue hiking for longer. So all those people who've been hoping that the Fed was going to pivot here in Q3, my sense is that trifecta of data is pushing that pivot out and giving the Fed more room to continue raising interest rates higher. Do you see similarly, or do you see something different?
So this is why I love you, Adam. You come up with the absolute best questions. So I'm gonna let you pick. Which one do you want me to tackle first? Do you want me to do the jobs report, twilight zone that they came up with, that number from the Department of Labor, or do you want me to talk about the Fed pivot? You pick it.
Well, let's start with the jobs.
Okay, all right. Let's talk about that. So where did this number come from? Over 500,000 jobs were created. That's one measurement of employment in the economy, but there's other clues that we could gather. First of all, the ISM, the Institute of Supply Management, has a very, very well-respected survey. And they survey both sectors of the economy, manufacturing and service. Both those sectors show that jobs shrank last month, okay? Let's look then at continuing and initial claims. That number was 160 a few months ago, and it shot up all the way to 260,000 initial jobless claims a week. And the continuing claims are rising. That's another clue as to why you don't believe that this number could actually be real. So they came up with this number, and that led people to believe that the Fed's going to be more hawkish. And the Fed is built upon labor economists. So if they get this very strong number, even though it has no semblance of reality, then they're going to be a little more hawkish. I agree with that. But when you talk about the Fed pivot, when I think of a Fed pivoting, I think of a central banker going to zero, back to zero interest rate policies. I think about a Fed that is lowering interest rates. I think about a Fed that is going back into quantitative easing. What we're talking about here is a Fed that's pivoting from 75 basis point rate hikes, basically 3-in-1 rate hikes, down to hopefully 50 and maybe even 25 basis point rate hikes by the end of the year. Adam, that's not a Fed pivot. That's an excuse for Wall Street to rally. Now, Wall Street had a rally in July. It's a bear market rally. You're down 20% in the stock market. You need 25% to break even. We rallied back just barely 10. So it's an excuse to rally. Bear market rallies are usually 20%. That's the usual amount that they bounce off bottoms. But I'm not concerned about that. What I'm concerned about is getting the cycle right. And the cycle is about to take a vicious leg downward.
Okay,
oh, by the
great.
way, I forgot to mention the household survey. The household survey, which is another thing that the Labor Department does, they call up households and they say, hey, do you have a job? Do you not have a job? That had been showing job losses throughout most of this year. And they showed about 150,000 person gain last month. But nowhere, in other words, there's no corroborating evidence. Whether you look at ISMs, the household survey, if you look at the fact that GDP had been shrinking for 2 quarters in a row, there's no corroborating evidence that shows that net non-farm payroll growth could be anywhere near 500,000 people.
Well, and so this is why I'm glad you see through the same lens I do, and this is why I think it's so important to pay attention to is it's as if the pilots of a plane are flying at night, right? And the Fed says, look, as long as the job market is strong, right, we're going to focus more on demand destruction, right, and trying to bring inflation down. That's what Powell's been saying the past couple of months, very clearly. And so these reports are their instrumentation, right, that they use to make their decision, right? And so it's like the altimeter on the plane. Yeah, it might be faulty, but the pilot's going to fly. If he can't see out the window, he's going to fly based on what the altimeter says. And the jobs report that came out is their altimeter for jobs. Now, if the altimeter is wrong, and the plane is much lower than the altimeter is reading, well, it's going to fly into that mountain, right? But that's what the Fed's going to do because it's basing its decision off of what its altimeter is saying here. So, big repercussions if the jobs altimeter is wrong here. Okay, so if the Fed is going to continue to hike rates higher for longer, then as you're saying, Michael, we have a slowing economy here. If the Fed is hiking higher for longer, it's basically let me put it this way, it's pumping the brakes even further on economic growth, and we already have 2 contracting quarters of economic growth behind us, and not a lot of positivity going forward here. So this is sort of, in some ways, sort of the famous policy mistake that people are talking about, which is the Fed may be accelerating the slowing of the economy as the economy already is organically heading into a recession. Sounds like a pretty bad recession from what you're saying, but I'm assuming if the Fed is hiking rates higher for longer, it's only going to make that bad recession even worse. Is that how you're looking at this?
That's exactly how I'm looking at this. So let's look at one more piece of evidence of the fact that the labor market is very weak. How many times have you heard a high-profile corporation come out and say either A, we've stopped hiring, there's a hiring freeze, or we're engaged in layoffs? There's some, I can't list them all off the top of my head, but there's some very high-profile corporations who have indicated that they are now in the process of shedding workers and have stopped hiring.
So just to answer your question, I can rattle a lot off because I tweet about this almost every day.
Well, you want to throw a few out there? Amazon, Google, or what?
Yeah,
Apple?
well, I mean, so again, it's almost hard to pick a company that either has a big company that either hasn't implemented a hiring freeze or is already in the layoff phase, and a surprising number of big names are already in the layoff phase. Groupon, Snap are the two latest that just announced this morning. Amazon is a big one. I'll just mention because you threw it out there, because Amazon has laid off 100,000 workers in the past quarter, and it's almost kind of like on a stealth radar. Like, I haven't seen this picked up all that much by the media, but 100,000 workers in one single company is tremendous, right? And this is at the early part here, when in past videos, I've sort of compared to where we may be in the recession, at least from a job loss standpoint, kind of like you live in Florida, kind of like a hurricane hitting, right? Where before the hurricane arrives in force, the skies darken, you get a little bit of drizzle of rain, the wind begins to pick up. That's kind of the stage we're at right now, I think, and I'm curious to get your sense. Like, I don't think the force of the hurricane has really hit at all yet. And to your point, when it does hit, it's going to make whatever today's pain look like a micro wound.
So the conspiracy theorist in me, it's a small part of me, but not a large part. I have to say, well, where does this number come from? I mean, they're just making this up. Birth death model, you pick it, but is it a political thing to help the Democrats in the fall? And then I said, well, wait a second, that doesn't make any sense, because like we just talked about, this is going to cause Powell to really keep his foot on the brake pedal. Even regardless of who cares if we have peak inflation? As I said, peak inflation is not important. If it was CPI at 3% year over year going to 2.5%, that would be important, or even 5 to 4. But 9 to 8, with over 500,000 net new jobs created, that's going to keep Powell's foot right on that brake pedal, regardless if inflation peaked or not. And when you talk about the economy, let's talk about what the Fed has done so far. The Fed started hiking rates in March of 2022. They were at 0 to 25 basis points. So from March of 2022 to the end of this year, we are going to have a effective Fed funds rate of 3.3%, conservatively, in my opinion, and in the opinion of many others, including the dot plot. Okay? Summary of economic projections that the Fed publishes. You're going from 0 to 3.3%. And in a rate of change world where I live in calculus, that's the fastest rate of change that we've ever seen a Federal Reserve hike rate.
Right.
And monetary policy, Adam, as you know, not telling you anything you don't know, works with a lag. So what effect has the higher borrowing cost had on the economy? Not much yet, only tangentially and incipient and insidiously. Not only that, and I have heard nobody mention this, but I went back and, I did have a drink before I did this, because I couldn't take it without having one glass of Brunello.
Oh, well, nice.
When I went back and listened to the entire press conference from Jerome Powell, and nobody is really talking about this, but he had one question. I think it was the 30 or 31st minute of the press conference. He had one lousy question about the balance sheet. And I would encourage everybody to listen to my podcast on Wednesday. I record it, where I'm going to pull some verbiage analysis of the balance sheet and why it's reticent to shrink. And I'm gonna comment on that on Wednesday evening when I record my podcast, midweek reality check. Powell said this. He was asked about the balance sheet, and he said, well, the balance sheet started slowly because of some trade settling. And in my podcast, I'll talk about what he means when he says trades take some time to settle. Basically, the Fed buys a bunch of mortgage-backed securities, puts them on the balance sheet, but they don't record that trade as being part of their balance sheet for like 3 months in arrears. I don't know why. That's what they do. But then he said this, as I was drinking my Brunello. I said, I got to replay that. He said that the balance sheet will take, you ready for this? 2 to 2.5 years before it reaches reconciliation, before it becomes in balance, before it normalizes. And I said to myself, I said, Powell is now admitting that QT started slowly, and it did. It barely shrank. In fact, through most of the month of July, it actually increased.
Right.
What's going on here? It's supposed to shrink by 47 billion. Starting September, it's $95 billion a month. And that pace of balance sheet reduction is supposed to last for 2 to 2.5 years, right out of the man's mouth. So, in conclusion, this drives me nuts. When people talk about a Powell pivot. Pivot to what? Pivot to 50 basis point rate hikes? He's going to have the Fed funds rate, effective Fed funds rate at 3 and 3.3% at a minimum the end of this year, and will have drained a $500 billion out of the base money supply. Yes, Fed credit is money. Let's make no mistake about that. I heard some interviews where people were trying to claim that the size of the balance sheet is irrelevant. That is so wrong. The base money supply is physical currency, coins and paper money in circulation, and Fed credit. Why is that called high-powered money? Because credit is what they use to make loans. Every loan has to have a reserve. Reserves are credit, and credit is used to buy stocks, bonds, and make loans. So it is money. They're going to burn $500 billion of that by the end of this year. Between me having this interview and the end of this year is going to have the most destructive part of the eye wall of that hurricane that Jamie Dimon has said is spinning offshore. It's going to hit, and that is going to break the credit markets. And that's when the steepest decline of the economic growth and earnings and stock market returns will be.
All right, great.
Sorry for that rant. Sorry.
No. Well, it was very instructive, and it answered the question I was heading towards, which was using the hurricane analogy. When do you think this recession is really going to be in full force? Where are we going to see the impact of the current Fed tightening policy? And you're basically saying by the end of this year, we should really be feeling it.
It will be undeniable.
All right. And what I like about the way in which you look at the world, Michael, is through those second derivatives, right? You look through rates of change, and I kind of put this out there the other day. I'm trying to remember who I spoke with about the point you made, which was they had a chart. I'll see if I can find it. If I can, I'll put it up here. But it shows that the current rate of Fed tightening, or the current rate of Fed interest rate hikes is the highest it's been in the data series, right? And I likened this to taking a gallon of water. Michael, I could give you a gallon of water and give you a week to drink it, and you'd have no problem, right? Or I could shove it up against your face and force it down your throat all at once, and you'll drown, right? And that shows, basically the importance of rate of change in the equation. And if I understand you correctly, you feel like, what's going on right now with the tightening and the hiking is a lot like that sort of waterboarding, immediate waterboarding that may actually, cause the economy to choke, sputter out, whatever. You're laughing as I'm saying this, but is this hitting home in any way for you?
Thank you. I was going to say, thanks for trying to waterboard. The last time the Fed hiked rates above 2.25% was in the summer of 2018. By the end of that year, by the end of 2018, the S&P dropped 20% and the Russell 2000 dropped 30%. Back then, GDP growth was 3%. Today, it's 0%. And I'm being generous right now.
You are being generous.
I'm being generous. It's, we had 2 back-to-back quarters of contracting economic growth. Q3 could have a small positive, 0 point something, maybe even as high as 1. It's just too early. We don't have a lot of data. But the last time we were here, the stock market just went off a cliff in the context of much stronger growth, much less QT. We have much stronger QT now and much weaker growth. So, oh, by the way, I have to add this. Can you hear me, Adam?
Absolutely.
Okay, sorry. The market cap to GDP that we have now is higher than it was in 2018. And the leverage in the economy today is much higher than it was in 2018. So there's no reason why the level of interest rates that it takes to break the economy, which is always falling since the year 2000, it used to be 6%, and it was 5%, then it's 2.5%, then it was 2.25%. We're here now. We're at that juncture, that threshold where things tend to break down. And I looked through all of the metrics that I thought were, salient, that would make me think that this period of time would be better, and they're all worse. We are much more leveraged, have much more debt, much weaker growth, much higher rate of QT, and even a higher interest rate, at least as projected by the intentions of our Federal Reserve.
Right. So on that, you just a few minutes ago said that just on the current trajectory, you expect us to be at a federal funds rate of like 3.3% or something like that for the end of the year. Can this over-leveraged economy handle that?
No, I think I just went through all the reasons why. I mean, this is what I said I think the first time I came on with you was in July of 2021, and I said why this economy was going to break. It's just too massively over leveraged. We're at record total debt, nominal terms. In terms of GDP, we're at 345% total debt. That ties an all-time record. Guess what date? December of 2007, which was the precipice of the global financial crisis. So we have the most leverage we've ever seen in nominal terms, and even as a percentage of phony GDP, which is predicated mostly on printing money.
Right.
We're at that threshold, and I don't think it can handle that. The total market cap to GDP prior to the great the global financial crisis was I believe it was 104% of GDP. As we speak, it's 166% of GDP. It topped out at 210% of GDP. So we have a much more over-leveraged economy and a much more over-leveraged stock market.
Okay, great. So look, for all the reasons you gave us in this last one, that just sort of even just mathematically by your calculations, we're going to be beyond the mathematical breaking point for the economy around leverage within just 6 months or so. All right, so now we go to your market outlook here, right? So clearly the market has not got this memo, Michael, because everything you're laying out here seems to suggest that lower, perhaps vastly lower asset prices should lie ahead for all the reasons we talked about. So you say that we're in a bear market. So I assume you think the bear market is definitely not over yet. You've just explained that kind of, the full impact's going to be felt in the not too distant future. That's only about end of the year is only less than 2 quarters away now. So answer this any way you like, but how far low do you think things have the capacity to go, and how fast do we get there? Do we stumble along for the rest of this year, or is there going to be a point relatively soon where the market just is forced to catch on and prices have to start being adjusted downward?
Yeah, it's only God knows exact timing of these things. So, you can use
absolutely. I'm asking you to prognosticate as best you can.
Math and models is all we have, and they're imperfect. But based upon the trajectory of the Federal Reserve and how overvalued we are in the stock market, it wouldn't surprise me at all if towards the end of this year and in spring of 2023, we saw a 40% decline plus from where we are right now. And that would just bring the total market cap of GDP back to 100%. Of course, that's assuming that GDP doesn't fall, and GDP is going to fall. So just to bring the market back into some semblance of reconciliation, valuation wise, it would have to drop to about 40%. I would look at a minimum 3,100 to 3,300 on the S&P 500. That's a bare minimum for me. Of course, I'm always, I'm here every day and I trade infrequently, but I do trade as the model tells me it's time to make changes. So I'm, very capable and willing to change when the facts change. But I have to say, I think the Fed put is just so far away. If you think about what the Fed had to do in prior crises to get, to right the ship. So we have a crisis. The bond bubble has broken. We had the equity market break or starting to break, and the real estate market is just now starting to crack. And I want to get to I have a lot of thoughts in my head trying to get them out all at once. So
yeah, sure.
We have time. So
we're going to come back to real estate too. Don't worry about that.
Yeah.
Too.
So I just want to say that the bond bubble was undeniable. We had trillions upon trillion, over $10 trillion of negative yielding debt. The U.S. 10-year note was yielding 0.33% at the nadir. Junk bond market was 4%. Home price to income ratio, all-time record high, a record increase in home prices. And we just talked about the 210% total market cap to GDP. So we have this issue. These bubbles are bursting, and the reconciliation, I call it the grand reconciliation of asset prices, is going to occur. The Fed is going to do it, and just the business cycle is going to do it. But it's not just the United States. I want to hasten to add that over 80 global central banks are now tightening interest rates. The United Kingdom is projected to be in a recession in the second half of 2022. European Union, recession, second half of 22. Japan, in a recession. The United States, 2 back-to-back quarters of contracting growth. China, their manufacturing sector is in contraction because their real estate is in a debacle. The real estate complex is a complete mess. And in China, the real estate is the economy. So we have a global recession now. It's not just the United States. So I think this reconciliation is inevitable, and at a minimum, it's a 40% decline. Did I answer all your questions? I think I was going to talk about Powell too.
No worries. Well, you opened a bunch of doors here, and feel free to talk about Powell. But so you talked about magnitude, which was great. In terms of timing, back to my question about sort of when do you think the market is going to get the memo? Is it going to be as we begin to have these earnings recessions that you're talking about, where companies just start having to give out, just truly disappointing forward outlook? I guess my question is this something that you think is going to be breaking between now and the end of the year when the eye of the hurricane is here in full force? Or do you think that we're going to be in denial up until we just can't be?
Well, I think corporations will deny as long as they possibly can. I can't predict when the confessions will start to come from Wall Street, but I think the buy side is going to have an epiphany, and talking about a Powell pivot is ridiculous. People will have to protect their retirement. Anecdotally speaking, I have to say that people who are not in this industry, people who have 401ks and pension plans, how are you doing? I asked them the question. They say, I think we're doing really, really poorly, but I don't care because I know it's going to bounce right back.
Mm-hmm. Yeah.
Yeah, this is where I wanted to go. Thank you for leading me there. So in the past, the Federal Reserve had to cut rates significantly and go back into QE to right the ship. So when the dot-com bubble burst, the Fed had to cut rates by 475 basis points.
Mm-hmm.
In the aftermath of the great real estate debacle, the Fed cut rates by 525 basis points and had to go into QE. If you look at what happened, even in COVID, the Fed had to go back to ZIRP from 1.75 to zero interest rate policies, and had to promise unlimited QE. And here's the way my mind thinks about this, Adam. How soon after a 9.1% CPI print will the Fed be able to return to ZIRP and unlimited QE? I think it's going to happen. I'm not saying it's not going to happen. I'm saying it's going to happen. But that is going to be a painful pivot for someone who is known, renowned, world renowned for their pivots.
Right.
Powell, I call him Powell the pivoter. So he's going to pivot. He will pivot again, but it is going to be in response, ex post, the freezing up of the credit markets, where commercial paper can't be issued. Junk bond market is frozen. We had a lot of issuance in July, and everybody said, "Hey, look, credit spreads are tightening again. Let's start, tapping the credit markets." That's not what Powell wants at this juncture.
Right.
So when those markets freeze, Powell will assent to cutting rates slowly back to zero, and might have a tangential move towards QE to try to unfreeze the credit markets. But for them to go back to ZIRP willy-nilly like they did in the aftermath of the COVID breakout, I think is ridiculous. I think that is going to be he will be loath to do it, because what is he going to do if he has to go back into ZIRP and QE unlimited within quarters of having a print of 9.1%? He's basically saying, "Hey, I throw my hands up as a central banker." Well, we're going to have protracted stagflation for as far as the eye can see. Just live with it, because it's better than a deflationary depression.
Right. So let's talk about that for a second. So, he's trying to get CPI down. To your point, it's going to take a good while before CPI is back down where the Fed truly wants it to be, right? The 2% type range. So if things break, let's say they break at the end of this year, if CPI is, let's say, 6.5 at that point in time, what you're saying is, what happens to inflation when he does that, right? It goes through the roof again. And inflation, I don't know, it'd be really interesting to see. We may find out this answer. What do consumers hate more? What does the public hate more? Runaway inflation or a deflationary crisis? They might be willing to pick the latter.
I don't know. I would say they probably would love inflation until it becomes hyper. And then they start rebelling. They start gathering at the Eccles building in Washington, demanding some kind of change. But a deflationary depression,
that would probably do it.
Sorry?
I said that would probably do it. The inflationary, impact of returning to easing when inflation CPI is still at 6+, right?
It's not, it's not just inflation, Adam. So let's look at the duration. What would duration bonds? What would the message be to the U.S. sovereign debt market and our currency?
Well, this is actually where I was going, and if you don't mind, I'm going to let you answer, but I want to inject one thing for you to react to. So I've mentioned a couple of times in this program, Bill Fleckenstein, who says, if the Fed does pivot, or he believes it will eventually, but if it pivots and inflation has not been brought under control, so let's take this scenario where it hasn't been. He said that's the moment where the Fed completely loses the bond market's faith, right? The bond market just.
Amen, brother. That's exactly where I was going. I've written about it before. I never heard Bill talk about it, but he's exactly right. You lose complete confidence in your currency and your sovereign bond market.
Right. So your yields go through the roof, right?
Duration bonds would go through the roof, and long duration bonds would go through the roof. I'm just talking about what about municipal bonds? What about corporate bonds? So there's a lot of problems involved. That's why I keep hammering this home. That's why people, what the heck do you mean when you say the Fed's going to pivot? Do you mean pivoting from thinking about 100 basis point hike and maybe only doing 50? Yeah, that's going to happen. When you say pivot back to zero and back to an intractable expansion of its balance sheet, no, they're not going to do that unless and until we are in a deflationary depression where asset prices are just plummeting. By the way, we talk about the real estate market. We learned today there was a record, I love the rate of change like you, a record increase in home for sale inventory, month over month, record. And that's before we had really any, terrific hikes in by the Fed, or before we actually start dumping mortgage-backed securities. Those trades haven't even settled yet. The idea that this is anything more, this is why I get in trouble. I get in trouble because I actually have opinions. And by the way, I have a performance track record that is monitored by a third party. I have one flagship fund. So I can't say, well, we have all these models and we have something over here, we have something over there. No, I go out on a limb and I tell you how I feel, and then I have a performance track record that I have to stand behind. The idea that this is the start of a new bull market. I actually heard Tom Keene from Bloomberg. I love Bloomberg is the best of the bunch. I think you can see it behind me right now. The best of the bunch. When Tom Keene said on Monday, yeah, it's a bull market because the futures were green. It's a bull market. It's not a bull market. It is a bear market bounce in the context of a bear market that is growing much more intense and will be extremely pernicious to all of those people that own pension funds and 401k plans who tangentially look at their portfolio and say, it doesn't matter if I'm down 10, 20, or even 30%, because I know the Fed has my back. That is wrong. The Fed cannot save you until all hell breaks loose in the stock market and in the credit markets. And that, I think it'll be too late. Too little, too late.
Too late. And look, I don't want to crack this open. I too want to talk with you about this, but we just don't have time because this is a whole video in itself. But just today, the Wall Street Journal announced that public pension plans lost a median 7.9% in the past 12 months, their worst annual performance since 2009. Right. So, I mean,
you need 8% to break even, right?
Yeah, exactly. Yeah. So, we're already seeing the bodies start to float to the surface here, to steal a term from Stephanie Pomboy, and that's only going to get so much worse with the future that you see coming. I want to talk about housing very quickly, and then I want to get to the real meat, which is, okay, so you're a capital manager. How are you actually, deploying your capital right now, given your outlook here? But for housing, the stock market drops. The stock market's in a bear market. Yeah, Bloomberg and channels like mine are going to make a lot of hay out of that. But as you and I know, Michael, what is it? The top 10% owns, like, I don't know, 85% more of financial assets. So that doesn't impact the vast majority of the public, all that much. But 2/3 of households own their home, right? So that what happens in the housing market has a much more national impact on the wealth effect. The wealth effect. And so, we've been at record high housing valuations. We are now seeing a lot of data that shows that the housing market is finally looking like it's going to roll over here. And so 2 questions for you. How bad do you think this national rollover could be? And then secondly, how bad will the negative wealth effect that it engenders impact this recession we're talking about, right? Because as consumers feel less wealthy, they spend less, right? So is there, some are losing money in their retirement accounts, some are losing their jobs, but a bunch of them are seeing their housing prices go down. Is that going to lead to, accelerate the demand destruction that just brings corporate margins down even further because folks just aren't buying stuff?
So 1 in 5 houses are owned by an institutional investor. So there's a lot of inventory to yet pop up as home prices stop going up. It's a wonderful, it's a wonderful dynamic when you buy up huge tracts of single family homes, and then you say, oh, the poor middle class can't afford a home. I bought them a home and I'm going to rent it to them. And then my home goes up in price. So, balance sheet looks great. And I have a great cash flow as I raise their rents. That's wonderful. Wall Street, I hate, did I ever tell you how much I hate Wall Street? I abhor them. In fact, I have a picture in my office of someone that drew me 3 little pigs. Just disgusting that you would buy single family homes. I'm talking about, some, I won't name their names. How about that? But you know who they are.
I'm going to name a few. So anyways,
Blackstone, maybe Blackstone could be one of them. and then you rent it to people as and then you couch it as you're doing them a favor. So you're going to be selling those properties. They're going to be dumping them as they're no longer profitable and hurting your balance sheet. The inventory, as I mentioned, is rate of change basis is absolutely skyrocketing. I think home prices could drop 20%. They dropped 33% in the global financial crisis. But the underwriting standards were worse back then than they are now. So I'm just saying, and maybe because of mollifying effects, maybe ameliorated to only a 20% decline. A 20% decline, you will feel it in your pocketbook, especially since a great number of the homes with a mortgage right now have been purchased in the last few years.
Right,
Those
right.
people
So their equity is gone.
Their equity's gone. Equity is gone. Yeah. So that's definitely. And by the way, the consumer, and people say consumer is so strong. If the consumer is so strong, why is credit card debt surging? I think this month was the second month, 40 billion this month. That's the second most in history increase in debt. The first was a few months ago at 47 billion. So,
right.
If the consumer is so strong, why are they, I believe, I very strongly believe that they're relying on debt just to maintain their standard of living. They're forced to rely on debt to maintain their standard of living. And credit card rates are tied to prime lending rates, just like adjustable rate mortgage.
Which are going up.
They're going up significantly. So when people say, what is priced in? Is QT priced in? No. Are the Fed rate hikes priced in? Not at all. A bear market bounce, which is fooling a lot of people to go long the Reddit board stocks, the most, the Kathy Wood stocks of the world, the stocks that aren't going to be around in a couple of years. Those are the stocks, probably not going to be around in a few years. Those are the stocks that they're migrating to. I'd be very cautious chasing bear market bounces. I'd rather be unchanged or down 1 or 2% on the year than chase the top of a bear market bounce, which is going to just careen to lower lows in the next few months. And guess what? You can find me, have me back on, have me talk about why I was right or even why I was wrong.
All right. Lots to talk about there. First off, geez, what the hell did I write to myself here? Shoot, you're going to have to.
While you're thinking of that, there was a recent Census Bureau survey. 40% of Americans say that they are having trouble paying their bills. 40% of Americans cannot make their monthly mortgage and credit card payments. 40%. That's a survey from the Census Bureau. So that's why you're seeing this boom in credit card debt. They are forced into doing it, and their troubles are just, getting started, unfortunately.
So I'm right there with you. For folks that want to dive more deeply into the stats behind this, I did a video a couple of weeks back about the plight the consumers in. I'll put up a link to it here because as Michael is pointing to here, there is just I use the term parade of horribles. I mean, there was just a massive and fast growing number of data points that show how the households are, basically just hanging on by their fingernails and losing their grips. Okay, so I did remember what I was going to talk about. So first, Michael, you were talking about this, the false signals being sent by this current market rally. And again, that's the role of a bear market, right? That's the role of a bear market, right? Is its goal is to take as much money from as many people as possible. Some of the biggest market rallies we've ever seen have been within larger bear markets, and their job is to suck all the sideline money back in, right? And then do a rug pull. And crater the hopes and dreams and capital of those people. You talked about Wall Street, how much you hate it, and I'm right there with you. I almost hate banks just as much. And just to your point about the record credit debt, so you're right. So we are at a record level now of revolving consumer credit. B, it is increasing at the highest rates that we've seen, right? So you're totally right there. And what's so criminal right now is the average savings rate that your bank will give you, even despite the fact that Powell's out there raising rates now, is still something like 0.06%, right? I mean, it's as mathematically close to zero as you can come, right? But what are they charging you for the credit that they loan you? Average credit card rate, I think it's probably higher than this, but I want to say it's somewhere like around 17%. Or something like this, right? So they say we can't possibly pay you any more than almost zero given this environment, but we're certainly going to charge you an exorbitant amount more than that if you're going to borrow from us, right?
You're trying to get me riled up. I know you're trying to get me riled up. You
know
how many nights I've had with Wells Fargo? I have a lot of, I'm going to tell you how much I have in a checking account. I have a checking account, several checking accounts. I said, the Fed is raising rates. What are you still stuck at 0.05%? Yes. We are still offering 0.05%. What a scam that is. What has happened when when people used to offer toasters to get you to deposit money
Yeah.
in a bank, and then there was competition like what's your CD rate? They're offering you almost nothing if you don't lock up your money for years. Almost nothing.
Well, it's insulting. It's immoral. I would say I think it's almost evil, and it's societally bad, right? In other words, we have punished savers for the past decade, right? And we have disincented people to learn how to become savers. We've forced them to just go become rampant speculators, and that's not good societally, right? I mean, there is a point where we should be saying, look, banks, you should be encouraging people to save just for the societal good of it, but they're doing the exact opposite. All right, last point on this rant is making sure we rail on everybody here. So you talked about the huge increase we've seen in institutional ownership for housing stock. Again, I think that's immoral and a societal negative in the sense that you do not want to, I don't like excessive regulation, but you do not want to be in a world where too great a percentage of your housing stock is controlled by corporate entities. And we seem to be just hurtling towards that path right now. And you talked about Blackstone. There are a few other players out there that are doing this. There's two risks here I just want to quickly flag. One is that, as you were saying, Michael, if these guys get into trouble, well, then they can just dump a ton of inventory on the market all at once, right? And these guys oftentimes own lots of homes in the same concentrated area. So they can conceivably just crater a market overnight by dumping all this inventory on there. That may or may not happen. We're gonna see soon. We've already seen some dry runs of that, like with Zillow, where they were dumping thousands of properties, but they sold it to another big institution, so they all didn't hit the market, in the way that we're talking about here. But there was a headline by Blackstone just a couple of weeks ago. I can't remember the exact amount, but it was something like a 50 billion fund that they've socked away as a rainy day fund because they're seeing the same data that we are about the softening housing market. And they're saying, yeah, there's probably going to be a pretty serious correction. We're going to put aside this massive war chest so that we can descend and just buy up all this inventory, once the dust settles. And again, these bastards can way out compete with average, folks trying to buy a home for a whole variety of reasons. One, they've got this massive war chest, but they can borrow at much, much lower rates than the average household can for mortgages, right? So it's such an unfair competition. And again, this is just not good for society if one day we wake up and we're just all renters to our, corporate overlords. So it seems like you feel the same.
Well, I feel like you just gave a campaign speech, so you're not running for anything, are you? Because you got my vote.
Our interview with Michael will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as the little bell icon right next to it. And be sure to hit the like button too while you're down there. And remember, we're continuing our new practice of publishing my top takeaways from these weekly interviews. To get mine from this interview with Michael for free, just go to wealthion.com/AdamsNotes. Finally, if the challenging macro outlook Michael's detailed in this interview has you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks that Michael's mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Michael Pento.